We'll proceed as the syllabus say. My approach was for you to understand this one fully before we proceed. Because kwinago you will be going blindly. Muzikanga kuti financial statement preparation yake maidziwa. While in effect giving you to prepare a financial statement sumukuta. Also poet. Just indicate so dead area. Because the accounting one, where we do, let's say, those ledgers, they are quite important. You like it or not. The double entry, they are quite important. Because these are adjustments. They are the ones which you determine. For example, if we do a evaluation, how do I handle it? How do I handle it? So, even the mini semester, it was very much on this one. It wouldn't have made sense for us, let's say, up to ikafike chapter each, and you are failing to do a financial statement. I'm saying this because you are saying, only one. So, sitting galimbe my so if you one chapter or two chapters, the regulatory framework. It's unfortunate the way they are doing it, they are doing it, but you're going to regret it. Africa year 4. If someone come with a different approach, like the school approach did it, Mozalia. Because what will happen? Mugayamba Nchito, they will give you an adjustment. Graduate, can you do us a postage? We have seen it graduate. Posting into a control account, a transaction, control account, debit, control account, CR, motor vehicle expense. What is this? But the person says a graduate. The reason being, so this into he failed to understand the simple fundamental issues of accounting. That's it. So we'll proceed as you want, but that assignment, if you do have a right mid semester, you would have actually tell me an hour from year 2, year 3, financial accounting. Akupanga like on these areas. We should have concentrated on those areas. Kuma you postponed that mid assignment. That's what's suicide. Because the mid semester, even if it's chapter 2 or chapter 1, there's a reason why they put chapter 1 and chapter 2. It's financial accounting. And financial accounting, these areas which we are going, as per your syllabus, they are just into added to tertiary level there. So for you to miss that assignment and the mid semester and proceed going forward. Okay, let's proceed. So we'll start with this one there. Non-current assets. That's I-16. Now, you have done Mukapita balance sheet. When you look at the balance sheet there, I normally refer to as balance sheet. Not always paper. Financial statement position. We'll start with what? Financial statement position. Non-current assets. Non-current assets. Then MK. Current assets. Then you start with what? Land and building. Right? Land and building, make up. Let's say you say cost Here maikaja depreciation net, here net book value. Then mazaika depreciation hapa. This London building. Then mazaika plant, property and equipment. This one is subtracting this one in Mabuyao. Like that. Right? Then in China, let's say Mamaliza. Now, under this accounting standards, ikupanga up. This one IS 16. IS 16. So what we are trying to say, when we say standards, what we are trying to say, plant and equipment, when you're posting it here, put it at this level, what could have happened? A lot of issues will go into it. There's the issue to do with what? Depreciation, Depreciation, issues to do with what? Revaluation. You do revaluation account, Revaluation. Where, for example, the asset will say nearly 500,000, it has moved to 700. Issues to do with, for example, dispose of the asset. They'll come into IS 16. So this one is trying to say, you value this one at the cost, meaning the price which you paid on that invoice. You bought equipment at what price? 5 million. Yet, let's say you say bought equipment at, let's say 20 million. 20 million. Right, let's say check. Yeah. Check. Like this. With estimated life of 20 years. Estimated life of 20 years. What will be the entries for this one? It means you are going to open what? An asset account. An asset account. Then you are supposed to calculate what? Depreciation. You know how the depreciation interest goes into the account. Now, so here you have this 20, which will come in up. Right? So it will be like a depreciation using straight line, 20 million divided by 20 years, which will give you the 1 million. So it means here you put the 20 million. Here, 1 million. Net book value, it will be now what? 19. So under this one, it says valuation of assets. There are two ways of valuing an asset. Valuing of an asset there. So under this one there, initially, they have used what is known as a cost model. They have used what is known as a cost model. Less depreciation and then another impairment. Now, the following years, busy by phone, right? Now, what we have done here, upper the first scenario, we have used the cost model. Now, it's not always that the equipment can be at 20 million. It can never happen. It can never happen. It is bound to change. For example, it can go up or it can go down. It's possible. Now, this is, let's say, first year. Second year, they will say, for example, evaluation took place. The asset is now 30 million. Maona? the asset aipanga revalue yapita ku 20 million. So how do they determine revaluation? It can be, for example, increase to many factors like interest rates, change in technology. The asset can appreciate, or it can even go down. So how would you determine kutu mukapange change that one there? So they said, and it's a good practice, that this is being your first year balance sheet. Kamu chaka chinacho, these assets, they are supposed to be looked again. But is the land indeed 1 million? You can revalue it. So you will take what, for instance, a physical planner, they will value that asset. So what conditions? So an asset is valued at cost or the valuation going forward. The valuation there. So the standard will say, for example, mwapangali value planting. Make sure you also do the same for land. You should not be selective. Ngati panapa current assets have. So you can have, let's say, land and the building, land and the building. Then you can have, let's say, equipment, equipment and the machinery. Then a motor vehicle, yeah, furniture and fittings. So normally is also is it timango zichula kuti plant and what and equipment, PPE. So they say, for example, under plant and property, mapanga value ma motor vehicle. Make sure you also do the same for equipment. You should not do one type of assets. When you have done a revaluation under IS16, it says do the same for the rest of the classes for the assets. Don't pick one. It will distort everything there. It will distort everything. So the important thing about that one is you say, for example, IS16 covers what? It covers plant, property, and equipment, which is concerned about what? It has a two valuation model. It has two costing model. This one. So there are, what are we trying to say? What do you need to know about IC16? IC16 covers plant, property, and equipment. So under this one, there are two methods of costing the equipment, plant and property equipment. There is a costing model and a revaluation model. Simply put, the cost model is trying to say at what price did that plant and property was purchased. So you take that one plus. So it's normally the cost. It can also be plus, for example, installation costed, capitalization. The cost which you incur in bringing that asset to usable form, plus installation cost. For example, equipment. You bought equipment in what? Let's say China. The transportation cost, import duty, putting that equipment on the factory, setting it up, all those costs. If it's new, they are supposed to be capitalized, isn't it? Accounting one. They are supposed to be capitalized. No, this is where that cost. then that cost will reflect in the financial statement. Now, come the second year, you are supposed to revalue, to assess the equipment. Has it appreciated in value or not? If he had suffered an impairment, do the necessary adjustments. Now, when there is a revaluation, the difference, the amount will first go to the revaluation account, then excess to other comprehensive income. So the key issue, those are the ones there. Know the costing model and the revaluation model. It's only touching plant, property, and equipment. There would be these things there. If you revalue, you cannot only do one class of the item there. The rest of the class of the transaction, they are supposed to be revalued. We are not talking about land and building yet. We are talking about what? Plant, property, and equipment. Now, how the questions will come onto this one there. Panama bought an plant and property equipment for 80 million, January 2012. The asset has zero residual value. Has zero residual value and was to be depreciated over its use for estimated life of 20 years. On 1 January, the asset was divided to. So it moved from 80 to 95. So they say now, calculate the amounts to be shown in the financial statements there. Amount to be shown in the financial statement. This is your first class, eh? Second. So where did you sign the first? You didn't sign. But I told you what to do it. Yes. Otherwise, I'm not marking that assignment. It will be zero. So we are saying it moved from 80 to 95. So the calculations there. So first of all, so it's 80, it has moved to 95. There are several things which will happen. So this was in what? 1 January 2012. 2012. And it was revalued on 1 January 2015, 2015. So they say this one has what? 20 years. Right? 20 years. So from here to there, it's how many years? 3? 2012, 1. It's 4 years. 1 January. Right? 1 January, kafika December 2012, right? Then inayo December 13. Inayo December 14. Inayo December 15, right? Ndima December, right? 1st January ndoti December kuthera apa. So meaning you calculate first depreciation kuthera apa, not including that one, right? So you say, for example, depreciation 2012 to January 2015. Get? So it's here 80 million divided by 20, which is each year. It will be what? 4 million, right? 4 million each year. So for 3 years, total depreciation was what? 4 times what? 3, which is 12 million. Right? 12 million. So it means, let's say, so NBV, it will be what? 80 cost let's say cost upper evaluation, then here to be the difference. So we are saying 1 to the third year, you have 80 million less the depreciation, which we calculated to be what? 12 million, right? 12 million, which will give us, my calculator, right? People, then that is my calculator. Eh? 68 million, right? So this is 68 million is at what? 1st January 01 2020 what? 15, right? Okay, so this is the net. Let's put this net book value issue. The difference, difference. Understanding cycle, we'll put it will be like this. Situation reserve, which will be the difference between these two. Now, this is the NBV at the 1st January. Now, that it should be 1/01/2015. Now, but on the 2015, they said it went to 95. What are they trying to say? It moved from 68 to 95. Meaning, balance it much. What is that? Statement, okay, financial position statement. It's like this. You have the cost, you have the depreciation, then you have the NPV there. So equipment, they say 80 up million. Here you have 12 million, right? Then you have that what? 68. Like that. But this is no longer at that 68. It has gone to 95. So you put 95 there. The difference is where out. What's the difference if you subtract? You have 27, like that. Then the depreciation is there. So after 3 years, there is remaining of what? The period there. Yeah? 17, it? 17. So you say 68 divided by 17. Then you have what? 95 divided by 17. Yeah, no. Wrong. 95, 0 divided by 17. Diba? Udah kung may sun maluan di ma phone. Maluan di kagret. 5,000,000 588 235 as your ibwera right under the revaluation it goes to bank calculate is so remember so good. The 95 should be here. 58 558 88 285 like that one 5,000,000. Here the depreciation is how much for this one? Will it change or not? Yeah, here we are calculating 4 million each year for this one under this one because it's a straight line yet. For this one, it means charge you some charger yet for this value there. So here you have what? 4 million under this one. So the difference will be what? 5 and 4. Eh? 1,000,000 5 8 80 so 235. So it will be a minus it. A minus. This one subtract this one. E color 60 and 64 it. E 89, 411, 765. Here, $25,411, 765. Yeah. So what we're trying to say now, the asset year one, it was 80, then it went down to 68. Now, so 1 to 3, financial position statement. So you have that cost there, you have the depreciation, then NBV. So year 1 to 3, you had 60, sorry, 80, the depreciation total in Aliba, 12,000, 12, which in other figure, 68. Now, year 4, there's appreciated 2, you start now showing the 95. Depreciation of what? 5, 5, 8, 8, 2, 3, 5. Yomwe yabwera nuku 89, 411, 765. Matana nayo. Then income statement. Income statement. From year 1 to 3, under the expenses, you have your depreciation. Which will be, it will be 12, what? Yet? Total scenario 12. 12. But many year 4, it will be what? 5 feature put here. 5 million, 5, 88, 235. That's how you show it. Put the under is a better. Then each source up. Then in the assets, yeah, those are the assets. Then you are supposed to say revaluation, reserve. Revaluation reserve, where does it appear? Under income statement. Which section? Under the financial statement. Equity and what? Liability, is it? So, muzalemba. Because this is it, the muzalemba pamusibaji. Equity and liabilities, right? Section. Where akumakala capital, retained profit, zimagwera kumene, right? So, revaluation account is a revaluation reserve. revaluation reserve mukaonesa this amount hiyo 25,411,765 like that. Ndoti mwamba mundo mazakara will be what? The equity return earnings total plus your total equity. Revaluation reserve will don't go where there is fixed assets, current liabilities. It will come under what? Equity and liabilities. Ndoto matana na yomene. Any question or no comment on that one? Now,
how we show the information.
So we have this one as a revalue amount, the new depreciation, then the net book value. The difference between the 80 and the 95 is coming 27. But you don't take the whole 27. Why? There is also difference between the depreciation values. So knock out that effect there. Then you take this one to the revaluation account. When there is a revaluation, three things will happen. The change of the item as it appears in the total value in the assets, in the financial statement, change in depreciation value, then there will be a new item, revaluation amount, showing the difference between the cost and the revalued amount. I will send you that one, don't worry. I will send you that one. Now, you know depreciation, eh? You know depreciation, eh? That one. So for that chapter there, when we are doing the depreciation, you must know what is known as impairment. Impairment. For example, this asset here, 80, is an equipment. It's an equipment. Now, let's say there's a, how can I give a good example? Let's say I want to use the same example. Let's say instead of, you know, the equipment, let's say for example, you are using, let's say for making bottled water. Making bottled water. And there's a new version for that machine. There's a new version for that machine. It costs you 80 million. Year one. Then after 3 years or 4 years, there's a new version for that one. They have upgraded it. Meaning that one is what? It's no longer in value. For example, a good example could be, let's say, a laptop like that one. Yeah, it's a land, let's say, when you use 12, there's an upgrade for that one. A high tech for that matter. So it means on the open market, that one there, if you go to fetch it, you cannot go and fetch that value. Right? You are supposed to, you will say maybe instead of 80, it has gone to 50 million. But in your books, you are still showing as that item is 80 million. So where there is a loss in value on an asset, depending on the market forces there, there's what is known as what? You say that asset has been what? Impaired. So you say that one is what? Impairment. impairment. So under normal practice there, remember we are saying under IAS 16, when you are revaluing the asset, Moses Bank revalue everything, not just a motor vehicle, but including plant, property, and equipment. Under impairment there, when there is an impairment, you review the whole class of assets. Determine, put it in terms, has it been impaired? So there are different ways you can determine impairment. There are several factors which can be impairment. There can be external information, there can be internal information there. What have I said? You didn't understand which part, for example, which part? Impairment. Impairment was saying a loss in the value of the asset in terms of the market value, which it can go. It has suffered a value. The value is no longer the ones which you are representing. You are saying your phone is worth, let's say, 200,000. But does that mean you can sell that one at 200,000 on the open market? It can be 70,000. Why? There is a new model for that phone.
That difference with depreciation.
Is
that difference with depreciation?
No. There's a difference. Move over for flower. What's the difference between impairment and depreciation? Depreciation will represent loss in value of the asset as it is being used. You are using the asset, you are supposed to provide a cost, the usage. Depreciation will tie to loss value due to usage. Use. It means it's costing you something. In accounting, you cannot just say, for example, 80 without showing a cost. What you are trying to do is that when you are doing depreciation, you are trying to allocate an apportionment of that cost as it's being used and charge it to income statement. You are using it. While you are using it, you are charging that one. That cost can suffer impairment. It can suffer impairment. Like the opposite, your evaluation. Right? Please note the difference. That's a good question. Note that difference. So, for example, there you have done goodwill. You know goodwill? Goodwill. What is a goodwill? Yeah, company reputation. Company reputation. So the reputation of the company, like for example, Bambino reputation. If they have a good financial accounting system, they can be able to capture that. Like a branded reputation. It's let's say 2 million. So this 2 million will depend on several factors. For example, how the school is governed, the courses which are being offered, the caliber of the lectures. Then let's say after 2-3 years, there's been a, let's say and which is the flagship course on this campus? The flagship course. Eh? For which program? I mean program kuli community development, social work. Yeah. Let's say that one there. Then the government said, don't offer again this one. Right? The school, in terms of going to study Kamaria ticket, it will suffer something there. So it means something in terms of Muipanga value school, you cannot value it the same, right? Now, when it determining impairment, you have external factors, then you have internal factors. For example, internal factors, under goodwill, you can say, for example, loss of key management. Loss of key management. That one can happen. It happens. For example, where in advanced economies, a CEO has resigned or a key management staff has resigned, you will see the stock value of that company will go down. Mnavapo it? Mnavapo kaya. So there can be internal factors, there can be external factors. For example, the condition of the machine has its performance is no longer as it was before. You actually know this machine is not working as it's supposed to be. Or it can be external factors. There's a new version of that machine. There's a change, for example, in what? Interest rate. If that asset is linked, when you are varying it, it was linked, let's say, for example, to interest rate, it has changed in value there. It has changed in value. So, under impairment there, know the conditions for impairment. They can be external or external. So, when we are reviewing for impairment, under, let's say, for example, PPE, you also do the same. The rest, check whether there's an impairment in the asset. All of them, not just one there. So I've said it there, revise the depreciation. For that one there, provision for depreciation, interest. 1, 2, when there's a revaluation account. Because what we did here, when we are taking that, that 20, is it this amount 25? This one, it will come from revaluation account. From the revaluation account. Then 3, assets, interest. 1, acquisition of the asset. 2, disposal of the asset. Then 3, the revaluation. In your previous slide, you are doing, when we say we have purchased a motor vehicle, what is that one? We have sold the motor vehicle, what is it? Then you add revaluation to that account, what happens there? For this revaluation now to appear on the financial statement. On the financial statement. This one. Because if you look at the assignment, there were those adjustments. Let's say under inventory. So there were 2 values, in up, in up. Which one do you pick? Those are the adjustments which will happen here for them to end up in the financial statement there. Yeah, any comment or question on the That one. Let me send you that one. Ningawiwa nimeona ngati nakutumizirani. So for the mid semester, make sure you revise those, which I'm saying here. Depreciation, then why were you printing it, the one for audit? Hmm? Hmm? Then let's look at this one there, borrowing costs. So borrowing costs. So we are saying, for example, you can borrow, let's say you can go to the bank, let's say borrow 100 million, let's say to construct, let's say you have a factory or office building, then you start building it. So under this one there, ISA 23. So this building can take, let's say, 5 years or 5 to 6 years. Under 5 to 6 years. Should you wait to say, this is the cost of the what? Of the building, or this is the amount which we need to recognize? Because one thing for sure, you will be paying what? Interested each year, as per pegged on the what? On the loan amount there. So under ISA 26, when it's a qualifying asset, they will literally say they borrowed this amount to be used for qualifying asset. It's not any borrowing. For the ISA 2023 to actually translate, for you to capitalize borrowing cost, it's only on qualifying assets. So they'll say this one is a qualifying asset under IC 23. So any cost under borrowing which is on a qualifying asset, if they say it's a qualifying asset, you are supposed to what? To capitalize. You are supposed to capitalize. So what they try to say is that, for example, when they have borrowed there, it has met the conditions that this one is a qualifying asset. Then the amount needs to be capitalized. So you'll be like taking a portion, capitalizing the payment of the expenses. So expenditure, capitalization of starts, expenditure on the assets commenced, the borrowing costs are being incurred, the activity necessary to clear the asset to be what is booked. So when these ones have been satisfied, then muyamba capitalization. Expenditure on the asset commences, that means muyamba, whether it's what? Construction or so ever. The borrowing costs are being what? Incurred. The activity necessary to prepare the asset are what? In progress. Not let's say, for example, you have borrowed it to construct a factory, then the money have just sit in the bank. The amount have sit in the bank there. But we are saying, for example, you have borrowed, you have studied everything, the land preparation is there, the architect have done everything, the feasibility is actually done, everything has been finalized. You have now started. That means you have started incurring the cost on the borrowing asset. So there's that question there. So they say Colombia commenced construction of an item, plant, property and equipment 1 March 2015 with a fund of 20 million loan. Rate of interest on the borrowing is 5%. Now, due to a strike on construction took place between 1 October and November, then calculate the amount of interest to be capitalized of the non-current assets as at 31 December 2015. Now, we are saying the asset necessary to pay in progress, the asset is being incurred. There's a reason why they have put it, for example, this one there. No construction took place between 1 October and 1 November. It started in March. Mambo go now. So it started in March. So they say, how much should be capitalized there? So the loan is 10 million at 5%. At 5%. So it started on 1 March 2015. So they say now the reporting date is 31 December 2015. How much should be capitalized as per as on a pro rata basis? So the interest rate, the interest charge, not interest, the interest charge, it will be 10 million times 5%, which is what? 500,000, like that one. But from this period to December, it's what? 9 months only, right? 9 months. So capitalization, it will be there times 9 over 12, which is
But